So, have you ever been wondering how lending and borrowing works in DeFi? How are the supply and borrow rates determined? And what is the main difference between the most popular lending protocols, such as Compound and Aave? We'll answer all of these questions in this video. Before we begin, if you want to learn more about decentralized finance and the technology behind it, make sure you subscribe to my channel. You can also check out our free guide to DeFi that I will link in the description box below. Let's start with what lending and borrowing is. Lending and borrowing is one of the most important elements of any financial system. Most people, at some point in their life, are exposed to borrowing, usually by taking a student loan, a car loan, or a mortgage. The whole concept is quite simple. Lenders, aka depositors, provide funds to borrowers in return for interest on their deposit. Borrowers, or loan takers, are willing to pay interest on the amount they borrowed in exchange for having a lump sum of money available immediately. Traditionally, lending and borrowing is facilitated by a financial institution, such as a bank or a peer-to-peer lender. When it comes to short-term lending and borrowing, the area of traditional finance that specializes in it is called the money market. The money market provides access to multiple instruments such as CDs, repos, treasury bills, and others. In the cryptocurrency space, lending and borrowing is accessible either through DeFi protocols such as Aave or Compound, or by CeFi companies, for instance BlockFi or Celsius. CeFi, or centralized finance, operates in a very similar way to how banks operate. This is also why sometimes we call these companies crypto banks. BlockFi, for example, takes custody over deposited assets and lends them out to either institutional players, such as market makers or hedge funds, or to the other users of the platform. Although the centralized lending model works just fine, it is susceptible to the same problems as centralized crypto exchanges, mainly losing customer deposits by either being hacked or other forms of negligence. You can also argue that the CeFi model basically goes against one of the main value propositions of cryptocurrencies, self-custody of your assets. This is also where DeFi lending comes into play. DeFi lending allows users to become lenders or borrowers in a completely decentralized and permissionless way while maintaining full custody over their coins. DeFi lending is based on smart contracts that run on open blockchains, predominantly Ethereum. This is also why DeFi lending in